welcome to this CNBC TV18 special, The Art of Wealth Creation. Investing guru Phil Fisher once said, it seems logical that even before thinking of buying any common stock, the first step is to see how money has been most successfully made in the past, unquote. This simple question forced one of India's foremost wealth creators to ponder about what are the key lessons that he himself can draw from his 19 years of obviously successful investing. And the result is this book, The Art of Wealth Creation. And with me today is the author of this book, Raamdeo Agrawal, arguably India's most successful and methodical investors. Well, just a word more on the book. This book isn't a work of a month or a year. It is a combination of the best of 19 separate wealth creation studies that Raamdeo has brought out over the past 19 years. In that sense, this book represents the best of his best efforts. So Raamdeo, on that note, well, first let me start with a formula. Have you evolved any formula over the last 19 years for, first to check whether the stock passes muster for you or not?
Yeah, so I think in stock market, if there are a million guys, there are a million ways of making money, and you have to find your way, and it takes a lot of time for you to, you start from nothing and then slowly start getting what is wrong, what doesn't work for you and what works for you, and it is very expensive process.
Yes.
Time consuming as well as expensive. Every time you commit mistake, you realize that that was not the way to do it. So now after, like I bought my first stock in 1980, and this is 35 years.
Okay.
This study is only 19 years old, but for 35 years I have been buying stocks and thinking about them. So after 35 years of investing, I think we have, for last one and a half years, 2 years, we are saying that our investment style is QGLP, quality, growth, longevity at reasonable price. So first thing is the quality of business and quality of management. So a fantastic business quality, which has a long-term tenure, say a Coke, a Hindustan Liver or a Nestle or you name it, you name them, and so fantastic business. Now met with fantastic management. Now both are 100x in their own capacity. Okay, so terrific business run by terrific management. I think actually you don't need anything else.
Okay.
So that's the thing. So Q stands for that.
Okay.
Then quality is done. Then G, growth. What happens is you can get a great business, but if it is not growing, great business is say valued at 10,000 crores, and then it is not growing, so it will remain 10,000 crores or 12,000 crores for a very long time to come. So you need, for a change of the value, sustained change in the value, you need positive growth.
Absolutely.
For that to come to the investors. Then third is longevity. Now how long this growth is going to be? Because ultimately entire investing, a lot of it is about the terminal value. And terminally, after 10, this high growth is going to continue for 10 years, because it cannot keep growing at 25-30% perpetually, otherwise the whole world will become your company. So clearly there is a limitation to the growth. So how long, how much growth is going to happen, and how long the goodness of the company is going to continue. So good business and good management and growth, all these things, how long it is going to longevate. And then eventually investing is all about purchase price. Are you paying too much for this? Once you have gauged the quality of business, quality of management, growth, longevity of goodness and growth, then how much you are paying. So it's at some level it is mathematics, but still, knowing that you are not paying too much. If it is worth, in your estimate, it's going to be 1 lakh crore, are you paying 10,000 crores, 5,000 crores, are you paying 50,000 crores? So then reasonableness of the valuation comes. You don't have to buy very cheap, but you should not be exorbitantly paying for something which you love.
Now, let me come to the first pillar that you create, quality. How do you judge the quality of business? How are you sure that this business, should it be a monopoly? Should it be an oligopoly? What gives you to check that box of quality?
So that's the actually, see the order in which I said Q, within Q also business check is the first. Okay, so you have to go, at least I go very methodically in that process only. So if you, the moment you say is it a good business or bad business? So first thing is what is the current return on equity, I mean current return, unleveraged and leveraged return on equity, return on capital employed. If it is 5-10%, then I need to know the story. Is it going to go to 20-25?
Okay.
Then of course you are into a very interesting situation. But if it is not so, in fact I don't like anything which is less than 15-17% ROE. Basically I am looking at return on equity of more than 20-25. I love 50-60%,
Okay,
but they are very rare. So that's the first this thing. And not only this year, what has been the track record of last 5, 10, 15 years? Is it performing continuously very well? Is it very cyclical? Is it, then once that is established, then you go to the next level. What kind of competitive situation they are? See, one is the goodness of the company, then the competitive situation. So today are they making it because of some tailwind, and tomorrow once the tailwind goes away, then this entire franchise is gone. So it's a one night stand.
Okay.
So it's not, so investing is not about one night stand. You are buying for 5, 10, 15 years. You are paying P multiples of handsome P multiple. See, the moment you tell me this company, we open that data sheet where 15 years everything is given, and there you immediately go and see what is the cash flow, what is the interest coverage, what is the debtors level. Do they sell? See, there are 3 types of terms of trade. I mean, these are all there in the studies.
Yes.
One of the things is the terms of trade. So how does it work, the terms of trade? If it is a strong company, they will be able to collect their dues either immediately or even before.
Okay.
Even prepaid.
Yes.
So lot of companies, you will find that in the same trade, they are selling the same pharmaceutical. Somebody gives 90 days credit, somebody gives 60 days credit, somebody gives 30 days credit, somebody doesn't give any credit. Now that shows. So when your ROE is high,
that his quality, his product has demand.
And on a sustained basis, his debtors levels are literally zero. That tells me, boss, he's in the business.
Okay.
Then third thing is confirmed by, he doesn't borrow.
All right.
This kind of guys doesn't have to borrow. Fourth thing is, his cash flow is absolutely strong. Fifth thing is, his payout is very high. If he doesn't need money and his returns are very high, then he'll be paying out also.
Dividend, yeah.
So when all these things are confirmed, we have cleared the first box of quality of business.
Okay.
Then the next comes is the quality of management. So you have to start. Then you exactly see this much is possible. See, all those things of goodness of the business is possible only because of terrific set of management. So this actually ultimately it has given a lot of marks to the management's capability to deliver all this.
Absolutely.
Okay, but still at the end of it, management can have competence, but integrity might be in question. Did they tell you the bad things in time? Or you have to hear it only from the CNBC.
Okay.
So so that decides more the integrity part, which is very important. If the company doesn't have integrity, don't even bother about investing them.
As so you say, 100x into zero.
Zero, yeah, because you are a minority shareholder sitting in some godforsaken place having 100 shares. If the guy doesn't treat you as an honest partner, what can you get? He might earn money, but he will not share with you.
Absolutely.
So integrity is very, very important. It's a deal breaker. Once great business, great management is there, then we become very interested. Then we try to figure out what is the environment for growth. One is now the growth opportunities have to be figured out. I would say this is most unexplored and most exciting part of the investing.
Yeah, because it's all that also means crystal ball gazing.
Yeah, crystal ball gazing, and it is not only about saying that okay, world is growing at 2%, India is growing at 6%, and this industry will grow at 12%, and hence this company will grow at 18%. It is not that simple.
Okay.
And then the growth, we are talking about earnings growth.
Yes.
Now, top line can grow at say 10%.
But we want earnings.
But we want the earnings. Now whether earnings will grow at 5% or will grow at 20%. So there are a lot of factors. There are a lot of operating leverages because there are a lot of fixed costs, there are a lot of variable costs. Say like Bata. Now Bata had 25% to sales as the employee cost, which they brought it down to 10%. So that 15% gain straight came down to the bottom EBITDA. And that led to almost 40, 50, 60% growth in the profit, when the top line actually grew at 10-12%.
I want to come to the one where everybody gets timid, price. What kind of valuations will you stop at? You will go to what, only to the historical valuations and not pay beyond that?
No, in fact we pay only
lower than historical valuation.
See, if you tell me, now I'll give you some metrics. If you tell me this is a company with 50% ROE,
Yes.
Okay, 50% ROE managed by a good guy with a longevity chance, and it is growing at 25% earnings for next 10 years. I am willing to buy at 35p also.
Okay. So it will be a
I'll be very happy.
PEG.
PEG. No, it's not PG. It's not that simple. So you have to look at the return on equity, sustainable return of equity, and then the growth rate. See, there are two powers. You buy the franchise, that is the dividend power, and then you have the growth power.
Yes.
So you have the franchise value and the growth value.
Okay.
So franchise has again to be split between the earnings and the dividends. See, if something is growing at 100,
because both are ways of making money.
if somebody is earning 100% ROE and 25% growth, and some company, there are second company which is growing at 25% with 25% ROE.
Okay.
I mean, one company will give zero dividend, and other company will give 3/4 of the profit can be distributed by a dividend. So my dividend value in a 10-year basis will be significant for the first company, and second company there will be zero dividend technically.
Okay.
So what happens is, in that situation, the purchase price, the price you should be willing to pay should be almost double or triple of what for the second company.
Fair enough. Raamdeo, we have to take a break at this juncture. But thereafter, we are going to ask Raamdeo how he is going to apply the same principles to the current world and help us identify some growth stocks for the coming years. In a minute. Welcome back to this CNBC TV18 special, The Art of Wealth Creation, and my guest is the author of the seminal book, Raamdeo Agrawal. Well, Raamdeo, let me pick up one stock that you must have picked up over the last 1 year and apply your investment philosophy to it. I have Jockey over here. Obviously, it's a stock that has grown from strength to strength, and in the last perhaps 2 years itself has quadrupled.
Yeah.
Tell us how your mantra applies to this stock.
Yeah, so very simple. I mean, they're a perfect stock for QGLP.
Okay.
So let's look at the quality of business. Now, this company caters to undergarments for men, and some undergarments for women also. So they are, I mean, of course, American brand, and worldwide also they have very good reputation. But in India, they are in the upper end of that particular consumer segment. And there is not much of competition. They have almost 70-80% share of that particular segment. There are enough undergarment manufacturers, but in that 100 rupees, 150 rupees, that so-called premium segment, there are very few, and they are very small. So, and this guy, I mean, the franchisee in India, first thing is size of opportunity is very large. Billion people. Eventually buying into this means you need at least 3-4 billion pieces. They do just about 60-70 million. When we first looked at it, it was only 20 million. Now, from where this story started, it is a storied kind of a stock. Warren Buffett bought Fruit of the Loom 5-6 years back in US from the bankruptcy court, and he called the old man to run this. I don't know how well it is doing now, but the owner of the Fruit of the Loom is Berkshire Hathaway. And then we said, why he's buying? So I realized that 37-38% of all the women undergarment in US is being catered by a bankrupt company called Fruit of the Loom. Now this category has that. See, people don't do brand flirting in this category. For the shirt or pants, trousers, whatever looking good, people try out. But in the undergarments, I think people are very happy, buy half a dozen and be done with. So you are a loyal customer, and if there is no competition, in that case all the business are going to flow through to you, and you will keep making money. That's what actually this company does. So the business is fantastic. They earn 50-60% return on equity, unleveraged, and they pay out 50% and grow at 30-35%. Okay, and that has been happening on the small base, and even at this base also they are growing. Of course, the growth rate will fall off as the base increases. So the quality of business is fantastic. Competition is less. The consumer is very well identified. Size of the opportunity is very large and growing opportunity, because that segment, as the prosperity is increasing, the size of the market is growing rapidly, and he is just encashing on that market. Second, management. Management is very transparent. I mean, you can see the books. So management has the competence to build the distribution, because just because the opportunity is there, everybody cannot do it. So they have shown that given the franchise, they have built the manufacturing, they build the distribution, and they have been able to encash on advertising, every aspect of sales marketing. So that business acumen, so competence is clearly visible. Integrity is not in doubt, because if you see the payouts and the books and everything, it is very clear they have the huge integrity. And passion is there because they are growing and continuous at 35-37%. So it takes both the quality part of it. Then growth, because it is, I mean, they do just
in a category where growth is
bound to come, and it is going to be there for 10-15 years. You know, so growth is there, longevity of growth is there, and since there is no competition some way, and there is no Chinese competition, there is no digital competition.
Okay.
So you know, so
disruptors
are not there. Okay, so so Q, G, and then L is taken care of.
Yes.
Now what valuation to pay?
Exactly.
Okay, so they are growing at 35%. Now when I bought it last, I paid 45p.
Okay.
Okay, we actually started buying at about 12, 13, 14p.
Okay.
When it was more like 300, 400 rupees. And then since then we have been buying for the clients at various prices. But the last call I took was when it was more like 45p. Now in last 6 months again it has doubled.
Okay.
So it has gone to more like 80p and all. So that's how now we have to wait for the earnings to catch up and things like that. But we are not out of the stock. We are still there at the margin. Probably might be buying also. But really that was the last call at 45p. So even at a very high p of 45, when the index was trading at 17 or 16, I was very comfortable buying.
Okay, fair enough. Well, let me come to two themes which I must discuss with you.
Yeah.
And this one is on the role of interest rates.
Yeah.
There is a beautiful quote you begin with of Warren Buffett: at all times, in all markets, in all parts of the world, the tiniest change in interest rates changes the value of every financial asset. Now, over the last 1 year, we have a new central bank governor who has promised, or at least indicated, that his goal is to take inflation to 4% from the 10% that prevailed when he took over. And consequently, therefore, you should expect interest rates also, if he achieved 4%, to fall to perhaps between 5 and 6%. Now, is this a game changer for those who are looking at Indian equity markets?
Yeah, it will be. Now, equities are nothing but perpetual bonds. On which whatever capital you are given, it earns 10%, 20%, 40%, depending on the companies and their fortunes at that moment, fluctuating. Unlike bonds, it is not a fixed coupon, but it's a variable coupon. So it's a kind of a perpetual bond.
Yes.
So what happens is when the interest rates fall, there is impact in the yield of this perpetual bond. Now, since it is not a science like bond market, it takes time for the markets to realize that actually the benchmark has gone down.
Okay.
So let me increase the discount rate.
Okay.
So if just to drive, if at 10% yield, say 10% Government of India paper risk free, if market is at 20p,
yes,
if the long term is at 20p, so 10% for the yield and 10% for the growth.
Yes.
I mean, I'm just making it simple. In that case, if the yield comes down to 5%, so then the yield valuation itself will go to 20 and 10% still stays for the growth. So market should move to 30p. But it doesn't happen overnight. It gives a huge opportunity in the market, and then the constituents, which are impacted positively, like banks or some other interest sensitives, they are still available to you, and then that becomes a matter of research and finding them. So you don't, I mean, one doesn't have to sweat too much about when the interest rate is going to fall, how much it is going to fall. Let it fall first, and then we'll act in the market.
Well, Raamdeo, before I conclude, I wanted to speak about blue chips. In your study number 16, you speak about 6 qualities of a blue chip. What are they? Yeah,
so in blue chip study, this is about there is a new concept called buy and die.
Okay.
I mean, you can buy for a very long time and don't bother about it. So what are those qualities of these kind of companies? So we studied this particular phenomenon that ultimately what you get is a dividend. So how do you get uninterrupted dividend? There are very few companies for 20-25 years uninterrupted dividend, and they also grow the earnings and profits. So basically we said 20 years of uninterrupted dividend, 5 out of 12 years of dividend increases, 5 out of 7 years of earnings growth, then average return on equity of at least 15%, and some level of institutional holding, and then you should be able to buy at a reasonable price.
Okay.
So basically, I mean, it all comes down to the same thing. What is your understanding of the company's capability to run the business in a predictable fashion and pay you out dividends.
Okay. Would you normally prefer buying mid caps rather than large caps simply because there is no growth?
No, I am. Who said that large caps don't have growth? Look at TCS. In last 5 years, it's grown 50% compounded. What more do you want?
Okay.
iShares has grown at I think 60% compounded. I mean, growth is very important element of my purchases, but I am very cap independent.
Okay.
I can buy very small cap, I can buy mid cap, I can buy very large cap, mega caps. So I'm not. I mean, it depends. See, if the global for your large caps are actually a mid cap in the global scenario.
Okay.
You know, so I think I'm cap independent,
Okay.
but clearly somewhere the mid cap means large mid caps are the I think the real, because there you get the history and you get good kind of you have a lot of data
Okay.
to see that yes,
Fair
future is ahead.
So on the contrary, you may even be favoring some large caps.
Yeah, clearly. I mean, I'm actually very large cap tilted.
All right, Raamdeo, we have to wind up the show. Give us your one-line investment philosophy before we say goodbye to you.
It's very simple. Buy right, sit tight.
Oh, I wish it was as easy as that. Buy right, I guess, is very important. We can all
So
sit tight.
it's a hard work, but buying right is 99% of the job.
And
then
not
the
selling
patience.
out is the
Yeah,
point.
I mean, once you're bought right, you're convinced that you will be sitting through. I mean, you're not a fool. Basically, when you don't buy right, you don't do your homework, then only the problem comes.
Okay. So the problem is which to buy. For that, you can watch the show all over again and you will know when and how to buy right. Thank you very much, Raamdeo Agrawal, for
Thanks.
joining
Thanks
us.
very much.